So we all know that investment is one of the pathways to wealth creation because you cannot save your way into wealth. You cannot save to become a billionaire. In fact, savings is good. However, savings is just capital protection while investment is capital multiplication. Investment increase the value of your money with time, thereby helping you and protecting you against the risk of inflation, but saving does not offer such benefit. The second thing you need to know about investment is that investment is for the future because money is tripartite in nature. Money is past, present, and future. The past of money is called debt. The present of money is called expenditure. And the future of money is called investment. So if you spend it all today, you'll be bankrupt in your future. So investment is for the future. Investment is you telling yourself that you are interested in a good financial future. So if you want to learn about investment, this is exactly what I'll be doing today. You are in the right place. My name is Philip Oyedele and I'm your finance coach. You're welcome to my YouTube channel. Please do well to subscribe. Don't forget you can share this video to somebody who also needs to know about investment. So today I'll be talking about the rules of investment. What do I need to know about investment? How do I start investing? When can I invest? All of these questions will be answered today. So the first rule of investment is for you to have a working budget, because between making money and multiplying money is managing money. In fact, if you cannot manage your money, you'll find it difficult to multiply your money. And a strategy to manage your money is called budgeting. And what budget does for you is to help you have a financial plan so that you can achieve your financial goal. You are able to know how much you can afford to invest. You are able to have calculated risk. You are able to invest amount that is within your power. Okay? So have a working budget. That's the first thing you want to do before you begin to invest. A good example, if you want to do the dollar cost averaging, whereby you have a particular amount of money that you are investing constantly every time, you must have had a working budget before you go ahead to do that, because your budget will tell you how much you are able to invest, how much you are able to put to your debt, how much you are able to put towards your expenditure. Rule number 2 says, understand your risk appetite. You see, investment and risk goes hand in hand. So there is no risk-free investment. So you must understand the amount of risk you are able to take before you go into any form of investment. You must also understand what we call the risk to reward principle. The risk to reward principle states that the higher the risk, the higher the return. The lower the risk, the lower the reward. However, no risk also means no return. So you cannot say you want to invest and you're looking for an investment that is risk-free. It does not exist. So, but you must understand your risk appetite. How much am I able to afford? If this investment should go bad, am I able to afford this? Can I risk it? You want to ask yourself, because the truth is, some of your investments will go bad. It's not every time you make money investing. There are some times, because of the risk, you also lose money. However, make calculated risk and understand your risk appetite. Rule number 3 says, never invest into what you do not understand. Listen, guys, financial education is the bedrock of financial freedom. Before you begin your investment journey, you want to have some education. It is true that we say the best time to invest was yesterday and the next best time is today. But don't make impulsive decisions because of that statement. You want to sit down, understand what you want to invest into, understand what the company does, evaluate the company, look into their track record. Does this company have a 10 years track record? Do they have a 20 years track record? Because if you invest into what you do not understand, eventually you may not understand how you will lose your money. So what you want to do in investment is you want to invest in only the things that you are acquainted with, the things that you understand. And if you don't understand and you want to invest, the best thing to do is that you go for the financial education. Don't forget again, financial education is the bedrock for financial freedom. Rule number 4 says divestment investment is important. Diversification is the master strategy in investment. So you see, you don't want to put all your eggs in one basket. And what do we mean by diversification? In diversification, you are diversing your investment. You are investing into multiple things. Let's say you want to invest in stock, for example. You don't want to invest into only one company. You want to invest into different companies so that you have a large investment portfolio. With that, you are minimizing your risk, because if one company didn't do well, you're sure that, okay, the other company should do well. So you don't want to put all your eggs in one basket. Now, let me tell you maybe one or two things that it means when we say don't put your eggs in one basket. First, it means do not invest into one type of industry. You see, there are people that when they want to invest, they only invest in real estate. So if something should go wrong in the real estate market, everything will go down the drain. There are people that they also invest only in tech. So if something should go wrong in tech, you are in problem. So you don't want to invest into only one industry. You want to diversify. Have some investment portfolio in tech, have some in real estate. Thank God we have like real estate investment trust now, the REITs. So you can invest into that too. So you also want to have, different investment portfolios. Have some shares here and there with different companies within different industries and different sectors. You want to invest in health, invest in agriculture, invest in real estate, invest in tech, invest in, semiconductor and electronics. You want to diversify. You want to build a good portfolio that allows diversification. So the second thing about not putting all your eggs in one basket is not having just one streams of income. And what do I mean by that? You see, if you do not have any form of investment, you probably have a stream of income, which is maybe a 9-to-5 or maybe a business. But the truth is, you're not going to have the strength for 9-to-5 forever. You won't have the strength for your business forever. What investment helps you to do is to have a leverage on a system that is already working. Other people are working for you to make money. Thereby, you are building multiple streams of income, because having only one stream of income is a financial risk. Of course, you don't want to take that risk. So don't forget that what we are trying to say is that divergement is important in investing, and you don't want to put all your eggs into one basket. So in my next video, I'm also going to be shedding more light and giving you more tips about investment, lessons from investment, tips on investment. Don't forget to like this video, click on the subscribe button, comments, drop a question, tell us the value you got from it, and share within your network. Let it be a blessing to somebody. And I'll see you in my next video. Thank you.